So today we are going to be looking at supply and demand for boom and crash. So I'm going to be sharing some approach, my approach. By the way, this approach works. I use it so much on synthetic indices when I'm trading synthetic indices. Uh, Now we on boom 1000 for this example, but you're going to find that the knowledge here is going to be helpful even on other synthetic indices. This is what I've realized about these assets. It's that they tend to trend in a given direction for long. Like if at all they are consolidating, they consolidate for quite long, and when they are to trend, they trend for quite long. So, what does that mean? If at all you're going to be profitable in these assets, I believe that you have to spot the trend as it starts. You have to you have to realize it before it starts, so that you are part of it when it's moving. Because sometimes I've realized getting in on, like, jumping onto the trend, sometimes it can be tricky for boom and crash, or even actually synthetic indices in general. So now the first step for this approach, you're going to identify a market structure shift. So now here for boom and crash, we cannot do a barry play. So I'm going to first highlight something. Then in the end, we are going I'll end by analyzing this move here. You get this move here. So now let's start here. The first step is for you to identify a market structure shift. This is what I'm talking about. A pattern like this. Something, if I told you the market is bullish, if it does something like this, and then if at all the market is bearish when it does something like this, you get. So we want to first identify a market structure shift. So each moment we are approaching a point like this, you get an area like this one here. You get an area like this one when we are on a higher time frame. This is where we are going to be so keen to identify entries. So um, yes, I understand there are more conferences that we can use that I may not be able to address in this video, but hopefully in upcoming episodes, or even for those that join my mentorship, already know this. You get. So now, let's start here. We can realize that here we have a market structure shift, as you can see there. Why? We can see that the market moved like this, and then it shifted downwards. You get, it shifted and broke downwards. So what does that mean? For us, we can highlight our zone. So we are going to be highlighting the last impulse move to the upside. You get, we highlight the last impulse move to the upside. For instance, like there, you get this bullish candle that bought. You get that pushed price up. You get. So now that is the first step. So now around this, you get, around this area, we are going to mark up all conferences that are around. For instance, if I told you to look at this zone here that you're seeing here, in this zone, we can see that we have a support and resistance level. You get, we have a support and resistance level. So we mark all of them. You get, because we know price at one moment will come back in this zone. So we shall be looking for entries to sell. So at the end of the video, we shall be refining. I'll be refining a certain point. Like we are going to refine, let's say this one here. You get, we shall refine that zone, and then maybe this zone here. But don't worry, that will be for at the end of the video. But let's first start back in history. So now when you mark something like that, let's say price has shifted, for you leave the asset to do whatever they want. Like it will go wherever they are it's going. You get, but this is your starting point. Here you realize that here it's sold, and this is your point that you've marked. You get. So now maybe if at all it is selling, where would you determine where it may end? Now if at all it's been bearish, it's shifted bearish, then for you, you're going to be, if at all you want to buy, you're going to wait for a point where, because now it is doing like this, selling. So now what are you waiting for? We are going to identify, this one is a supply zone, and we are going to identify a demand zone, external demand zone. You get. So now there is what we call internal and external points of interest. Now external extreme points, like we look for extreme points. So now we are going to look for a point which is possibly like this, where price shifted still. You get. We look out for such a point. Now let's say the market has moved, and now let's say this is, we mark out the extreme points like here. You get? We'll mark out this is the extreme. You get? Now, why do we mark the extreme? We have these points here that we are seeing. We have this one, and then we have this one. Now, at the end of it all, by the way, we are going to realize that when we are trading synthetic indices, you're going to have a number of them on your on your watch list, because sometimes jumping in along the way, like follow, like joining the trend, it might be hard. You get? That's why if at all you've analyzed and then it moves, let's say for a month, you have other assets that you're timing. If at all you were lucky enough to get in here, you can drop for a full month when you're comfortable. You get? So now, for us, we are not identifying, we are not marking up these points. You get? Because these ones will just cause consolidations. You get? Because you realize that these synthetic indices can consolidate. It can consolidate, let's say, for 2 weeks. You get? So now, for us, we can identify this as to be liquidity, but mostly when you are trading synthetic indices, the concept of liquidity is not applied the same way it's used in forex. So don't mind about that. But for us, we're interested in the extreme points, in these extreme points. And then you can see what is this extreme point. You can see that even here we had gotten a market structure shift. You get? We can see that here previously we had gotten a market structure shift, and then we had even this equal, like, anyway, liquidity here. You get? So now for us, we watch price as it's leaving this point to down here. So now these are the points that for us we get interested in. Now there are two anyway, there are like three incidents that may happen here. You get? One, let's say we have this zone here. This is one of the possibilities. It is possible that market will reach in this zone here and then it will shift again. You get? It will shift again on a lower time frame, as we shall see at the end. It may shift, let's say when you go on H1, it may shift. Then if it shifts there, you will take the entries. But nonetheless, if at all it doesn't shift, because you don't have to be so quick at taking entries here, you're going to go on lower time frames and then refine. You get? So now, then here it is possible that the market will break through and then later on it comes and shifts. You get? It comes and shifts. That is the next scenario. Or it is possible that the market will come, it will break below like this, it will break, it will come, and then it continues to break. If it breaks down again, then the downward trend is continuing. Then we can look for entries here and then we sell. You get? Those are the three cases that are likely to happen. Those are the three cases that are likely to happen. So now, but for this case, for us, we have this zone here that we shall be targeting for us, like, to sell. You get? And then the market has come. Maybe it was price was moving, and then for you had marked this previous shift that happened, and then for you, you're going to be watching this zone. You get? This zone. So now we watch it. Now what did we get? We can see that here, market on the same time frame, on the day, on the daily, still it came and shifted there. You get? It shifted bullish. You get? It shifted bullish. So what do we do? We mark up our point of interest. So we have this order block here. You get? Normally, if it's another block, we can mark up this inside formation. You get? We can mark up that inside formation. So now we've marked our demand zone. Remember, we have our supply zone. You get? But then for this one, I've overextended it. Sorry. So supposing price has not yet returned, even here, supposing, like, you just marked up your areas. So let's assume, let's assume the market hasn't pulled back. You get? But then we've gotten our shift here. We have our market structure shift over there. You get? So now this one becomes our demand zone, and then this one becomes our supply zone. You get? Now, for us, we are going to be waiting for price. You get? We are going to be waiting for price as it comes to these zones here that we've marked. Now this one becomes our trading range, up here and down here. You get? So now it is possible for these synthetic indices, they are really funny. It is possible that the market may come. It is not a guarantee that it's going to pull back. You get? It is not a guarantee, because an algorithm that is just printing this. You get? It is possible that it may just pull back a little and then it reaches up there. You get? It may just pull back a little and then it shoots here. That's why when it comes to synthetic indices, I've realized this: when you're using smart money, you're going to have a lot of missed. If at all you're using pending orders, let's say buy limits and sell limits, you may find that you have a lot of missed entries. You get? You may find that you have a lot of missed entries. But now, this is one of the ways of counteracting that. So now, at least we have these zones here, that we have this one here and up here. Here we are going to we are going to be looking for sales, and here we are going to be looking for buys. Lucky enough, you get? Lucky enough, you can find that here the market pull back in your zone. You get? So now when you go, I'm not going to go because this is very, very old data. It may be hard for us to reach here. When you go on, where do you go next? If at all you've gone, if you've gotten if you marked out the area on the on the daily, you go on the H1. You get? We're not going to be over refining. You go on the H1. We are going to be taking our entries on the H1, as we shall see. You get? So it doesn't matter. You're going to go to the H1. At most, if at all you want to go lower, you're going to go on M15. You get? And then here in this zone, what will you be saying? We are going to say at the end, uh, we will see another shift. You get? We don't take penny, we are going to see another shift. So when we see this shift here, we can take entries. You get? Because we know this is a demand zone. Likewise here, uh, likewise here, we can see that we had that zone. But I told you, when we highlight our zone like this, we can look at the other conferences that are around. We can see that within this supply zone, we can see that we have a level of resistance. You get? A level of resistance. So for you be watching as price comes. So what is your main point of interest? Before they come and reach this point, trust me, you're not selling. You get? Because they may be trapping you. You get? If at all you have a point of interest, and then within the point of interest there's another point of interest, at least rely on that. Why? It's going to minimize on your losses. You get? Likewise here, it was possible that the market would go up and then it shoots up. So sometimes you may get rejections here, but for you, as you have your zone, for you, you'll be waiting. Sometimes if it goes there, it may get rejections here, like it rejects there, but still it will come back in your zone, and then it will do a proper move. Let's say it does something like that. You get? So something like that. Now this now let's go here at the extreme here, and then we are going to do some kind of refining, and then I show you something really nice. So I've deleted the annotations that I had made. So now let's come here. What do we have? We are going to mark out our points of interest. You get? Now this is where we are heading. Let's start with where we are heading. We can see that the market is bullish now for boom 1000. It's bullish. Now we can mark out our shift in market structure. You get? This is our market structure shift. Now for me, I like to highlight this. I can highlight this the last impulse, the last opposite impulse run before the break of structure, or before the shift. So this becomes our order block, or our supply zone. So within here we have this level of resistance. You get? So we shall be keen. You get? We shall be keen on seeing how the market reacts here. So it's possible that the market will reach here. It's possible that it will reach there, and then it first sells even for a week. Then let's say it returns back and then touches there, or it can even go up. But I'm going to show you, for us, what we wait for. Before we get confirmations, we do not trade. You get? So at least we've highlighted our zone there. Now we have something else here for ourselves. It's if at all, how would you have caught this bullish move that you're seeing that is running upwards there? You get? Let me show you. So now we highlight a market structure shift. So previously the market was bearish. You get? Before, the market was bearish, and then we can see something like this. You get? So we can see that price shifted there. You get? Price shifted there. Now what do? We do this. We can highlight this impulse run to the downward side before the bullish move. You get? So in this zone, what else do we have? You get? What else do we have? We can see that we have a level of resistance, so a level of support still within. We can turn to the line chart. We can see that we have this point here that you're seeing here. You get? At least we are getting more confluences. You get, we are getting more confluences. So sometimes we can turn to the line chart, but this is our level. Yes, let me show you. So that is our level within our area of demand. You get? So now what do you do next? What do you do next? We are going to go on the H1. I told you, just supposing the market was rallying down. You get? Because I told you it is possible that there are possibilities that the market will rally down. It is not a guarantee. It will rally down, it proceeds, it continues down, it will retest. Sometimes if it retests, it will come. If at all they are willing to proceed selling, it will run and then it will do something like this and then it continues. But it's also possible that it will retest, it comes down and then it shoots back up. You get? But let's not complicate the issue here. You get? By the way, this approach is going to help you even on VIX 75, step index, and the rest. You get? So from H1 for this approach, we go to the from sorry, from the 24-hour time frame or the daily time frame, we go to H1. So now when we come to H1, let me first do this. Let's go to our zone that we've highlighted. Remember, this is our level of of support. You get this area here. So now here on H1 we are refining. You get? Here on H1 we are refining. So if at all this is our area, you get? Remember, this is our area of demand that we've highlighted. What are we waiting for? We are waiting for a market structure shift. You get? So for us, we're going to be taking entries as we've gotten a market structure shift. You get? So now, then what next? We can see that within here, what did the market do? We can see that we had this run like this. The market trend down. We got a small pullback there. You get? We got a small pullback there, and then it moved down, it pulled back, and then we can see that we got a shift. You get? So, or you can even turn to the line chart and then you see. So we have this move that is happening here, and then it shifted there. You get? The market shifted there. So now we go back to our candles. So now we highlight this zone here. You get? We highlight that zone here. So if at all you want to get somewhat like a sniper entry, for us we've gotten this area as our area of buying now. You get? It has confirmed the buys. You get? So as the market returns in this area here, for us we can take our entry stop loss below there. But now if at all you don't get in there, you get? If at all you don't get in there, our most concrete entry would be after we've broken above this area of support. You get? Because this line was a daily, at we drew it on the daily time frame. You get? So you can get in here, or if at all this is your demand zone, an area of demand. You get? This is what normally happens. Even as we break out, you get? As we break out, you may not get in inside here. You get? As we break out, if you properly marked it, as we break out like this, normally the market comes back near this point here, like this area of demand before it shoots up. You get? So you may not here, you wait for the market to rally back outside, confirming that it's rallying upwards. You get? And then you can place your entry as it comes to retest this area of demand. Then let me give you one bonus tip. You get? One bonus tip. You can add, if at all you've properly marked your zones on the daily time frame. This is for those that have sticked around till the end. You're going to go and add the 50 period exponential moving average. Then we come here, the settings are here. You're going to make it, the period is going to be 50. You get? Period 50. So you leave everything there. So this is what is going to help you to do. You get? So now when you add the 50 period exponential moving average, you get? When you add it, and then when you come on the H1, you get? When you come on the H1, if at all this is your area of demand, you get? If it's your area of demand, you leave it. You get? You wait until when price breaks out of, like it breaks upwards of this blue or this 50 period exponential moving average. You get? So for you, not until price shifts back up. You get? If I told this is your demand zone, you wait for price to come, and then it shifts up. You get? Like this. You get? If it goes up like that, you don't take entries immediately. The market price will come to retest this 50 period exponential moving average. You get? So when it comes to retest, because even price, if I told you you've studied continuous random variables, yeah, like we can consider this price also to be also another moving average. So as it crosses up, you get, we wait for a retest. Now if at all you want to be taking re-entries on the H1, you get, you wait for the price to come and retest the 50, like the 50 period exponential moving average. Like it will be moving as it comes to retest it. You get? It moves as it comes to retest it. It crosses out not until we reach our area of supply that we marked out on the daily. You get? That we marked out on the daily. So uh, for for the 50 period exponential moving average, we apply it as we've reached the H1 area. You get? So when we reach in this area of supply, you get, when we reach in this area of supply, for us we shall wait. You get? If at all it is a valid area of supply, you get, we shall wait for price to shift below. You get? Let's say it proceeds, this moving average goes up like that. We shall wait for price to come, let's say, to shift below. And then when it retests that 50 period exponential moving average on the H1, then we drop with the market to go down. You get? So avoid just taking entries along the way sometimes. Or you can, if at all you've properly determined, that we tapped our area of demand, and then we've shifted bullish on the daily, you can go on the H1, you add the 50 period exponential moving average. So you wait for the market to come and retest it. Now, when it comes to retest, you don't just take entries. Now, it requires some other conferences. Now, for those ones, like joining in along the trend, it may be a little bit tricky. So I cannot share it in just this video. But for now, I wish you the best. Keep practicing this, backtest it, and then you see how it works out for you.